Welcome to Fast Finance, where we simplify complex financial strategies to help you thrive. Today, we tackle an urgent topic: how to survive the incoming financial crisis of 2025. This is a critical conversation you won't want to miss. By the end of this video, you'll walk away with a detailed action plan to protect your finances, grow your wealth, and position yourself for success even in turbulent times. So let's dive in. Chapter 1: The Calm Before the Storm. Why are financial experts predicting a crisis in 2025? To understand this, let's examine the warning signs. Global debt levels have skyrocketed, surpassing 350% of global GDP. Central banks, in their fight against inflation, have raised interest rates to levels not seen in decades. This has led to higher borrowing costs for consumers and businesses, reducing spending and slowing down economic growth. Add to this the lingering effects of geopolitical tensions, supply chain disruptions, and volatile commodity prices, and the writing is on the wall. History teaches us that crises are cyclical. The dot-com bubble of 2000, the 2008 financial meltdown, and the COVID-19 market crash all followed similar patterns. Recognizing these signs early can give you a head start. Chapter 2: Preparing for the worst preparation is the key to survival. The first step is to build a robust emergency fund. Financial planners recommend 3 to 6 months of living expenses, but during a crisis, aim for closer to 9 months. Why? Unemployment often spikes during downturns. Having a cushion gives you peace of mind and prevents you from resorting to credit cards or loans with sky-high interest rates. If you don't have an emergency fund yet, start small. Set aside a portion of your income every month in a high-yield savings account. Automating your savings can make this process seamless. Chapter 3: Diversifying your income streams. One of the biggest lessons from past crises is the importance of diversifying income streams. Think about it. If your primary job is in an industry hit hard by the downturn, what's your backup plan? Side hustles, freelancing, and passive income sources are your safety net. Explore opportunities based on your skills. Are you good at writing, coding, or graphic design? Platforms like Upwork or Fiverr can connect you with clients worldwide. If you own assets like a car or spare room, consider renting them out. Even selling items you no longer use can provide a quick cash injection. Remember, every additional dollar you earn reduces your reliance on a single income stream, making you more resilient. Chapter 4: The Smart Way to Invest. When markets are volatile, the natural reaction is panic, but smart investors know that a crisis is also an opportunity. Reassess your portfolio. Are you too heavily invested in high-risk assets? It's time to shift toward diversification. Safe havens like bonds, gold, and other commodities often perform well during downturns. For equities, focus on sectors that thrive in tough times: healthcare, utilities, and consumer staples. These industries provide essential goods and services that remain in demand regardless of economic conditions. If you're investing for the long term, consider dollar-cost averaging. This strategy involves investing a fixed amount at regular intervals, which can help reduce the impact of market volatility. Chapter 5: Cutting the fat from your budget. Budgeting might not sound glamorous, but it's your strongest defense against financial instability. Start by reviewing your expenses. Identify wants versus needs. While it's okay to indulge occasionally, unnecessary subscriptions, dining out, and luxury purchases can drain your resources. Implement the 50-30-20 rule. 50% of your income for essentials, 30% for discretionary spending, and 20% for savings or debt repayment. Tools like Mint or YNAB can make tracking and adjusting your budget effortless. During a crisis, small savings add up. Cooking at home instead of eating out, canceling unused subscriptions, and even switching to energy-efficient appliances can make a significant difference over time. Chapter 6: Mastering Debt Management. Debt is a double-edged sword during a crisis. High-interest debt like credit cards can spiral out of control, while low-interest debt, like a fixed-rate mortgage, can be manageable if you budget wisely. Prioritize paying off high-interest debt first. Consider the avalanche method, which targets the highest interest rate balances, or the snowball method, which starts with the smallest balances for quick wins. Whichever method you choose, consistency is key. If you're overwhelmed, reach out to your lender. Many institutions offer hardship programs during economic downturns. Negotiating lower interest rates or temporary payment freezes can provide relief. Chapter 7. Staying informed. Knowledge is power, especially in a financial crisis. Staying informed about economic trends, government policies, and market movements can help you make timely decisions. But where should you look? Follow reputable financial news outlets like Bloomberg, CNBC, or the Wall Street Journal. Subscribe to newsletters or podcasts that break down complex economic issues into actionable insights. And don't overlook local news. It can highlight region-specific opportunities or challenges. Be wary of misinformation. In times of uncertainty, rumors and speculation spread like wildfire. Stick to trusted sources and avoid making hasty decisions based on unverified claims. Chapter 8. Seizing opportunities. A crisis is as much about opportunity as it is about risk. As legendary investor Warren Buffett says, "Be fearful when others are greedy and greedy when others are fearful." When markets dip, valuable assets often go on sale. This doesn't mean you should throw caution to the wind. Perform due diligence before making any investment. Look for undervalued stocks, real estate opportunities, or small businesses that could thrive once the economy recovers. Additionally, consider investing in yourself. Acquiring new skills, certifications, or even starting a side business can significantly increase your earning potential. This is an investment that pays dividends for years to come. Chapter 9. Building community resilience. Surviving a crisis isn't just about individual effort. Communities that work together tend to fare better. Engage with your network, friends, family, and local groups. Sharing resources, skills, or even just moral support can make tough times more manageable. Join online forums or social media groups focused on personal finance. These platforms are goldmines for tips, advice, and even emotional support from people navigating the same challenges. Final thoughts, Let's recap. To survive the financial crisis of 2025, you need to build an emergency fund, diversify income streams, reassess your investments, cut unnecessary expenses, manage debt effectively, stay informed, seize opportunities, and build community resilience. Remember, financial crises are inevitable, but they're also temporary. With the right preparation, you can not only weather the storm, but come out stronger on the other side. If you found this video helpful, hit the like button, subscribe to Fast Finance, and turn on notifications to stay updated. Share your thoughts in the comments. How are you preparing for 2025? Thanks for watching, and here's to your financial success.